Namaste and a very warm welcome to everyone. I'm Sanjay Chawla, CIO Equities at Baroda BNP Paribas Asset Management Company. In Market Insights, we cover some of the key elements which have a bearing on the Indian equity markets in coming times and in-depth analysis of key event, investment theme, and what is Baroda BNP Paribas funds positioning. In this session, the key focus is on the impact of monsoon on Indian equity markets and analysis of investing at peak of equity markets. To begin with, let us review what has been happening in the equity markets. The Nifty gained 3% in July and is up 9% YTD in calendar year 2023. Mid-cap and small-cap indices outshined large-cap and were up 5.5% and 8% respectively for the month of July 2023. Sector-wise, almost all indices ended in green, with power is up 9%, reality is up 9%, and capital goods sector is up 8%, gaining the most for the month of July 2023. Globally, Russia, Hong Kong, and Malaysia were the top gainers in the month of July. China outperformed the global markets as flows were attracted in anticipation of stimulus measures. Fed rate hike, China's stimulus expectation, and inflation trends were the key dominating factors during the month. Let us look at the big picture in terms of macros. IMF has recently upgraded its global outlook for India's GDP from 5.9% to 6.1% for calendar year 2023 on the back of momentum gained from stronger than expected growth in the fourth quarter of 2022. This is driven by robust domestic investment. While it continues to remain below our own RBI's forecast of 6.5%, we see this uptrend as a positive, and we note that if this growth is achieved, India will become the fastest growing major economy in the world for the third year in a row. Money chases growth. With India continuing to be top performing major economy in the world, it will be in the radar of global investors. Of course, there would be many other parameters to consider for global investors to invest, but India does qualify in terms of growth filters. India continues to be an island of growth. Let us see what is happening globally. US economy grew at 2.6% in quarter one of calendar year 2023 as against 1.8%. As was widely anticipated, FOMC hiked the policy rate by 25 basis points to 5.5% after a pause in the last meeting. Unsurprisingly, this is an unanimous decision. US CPI was lower at 3%, down from 4% in June. Good part is month-on-month increase is now 0.2%, which is much lower than 0.4% witnessed earlier. This indicates momentum in CPI increase is slowing down. The US personal consumption expenditure, that is PCE, data came in recently. This is based on the consumption expenditure or where the US households are spending, and this is one of the key data point that is keenly watched by Fed official for making decision. The personal consumption expenditure came in at 3%, down from 3.8% in May. All these factors lead us to conclude that inflation in US seems to be cooling off. We are hoping that Fed will take this as a lead indicator and would slow down or even halt the rate increase cycle, since higher interest rates are having the desired impact. Based on the recent GDP growth, inflation and other economic parameters, it does not look like that the US economy may not get into a recession in the near future, as was expected by the market participants. China. As you all know, China is slowing down. In that context, the Politburo meeting was an event that was keenly watched by market participants. The main challenge identified was the lack of domestic demand. As you may recollect, China has always been an infra-led economy, and consumption demand, given the size of the economy, was relatively low. Within infrastructure, housing demand was one of the pillars of growth. Given the slowdown in the Chinese economy, policy stance was dovish, and measures likely to bolster market confidence may be announced in future. China GDP is likely to grow at 5.2% in calendar year 2023 and further slow down to 4.8% in calendar year 2024. Housing credit is sub 5% and continues to be a key challenge for China. Now, let me talk about two positives and one negative on the Indian macro. The first positive point is the encouraging PMI data. July manufacturing PMI nearly was unchanged at 57.7 versus 57.8 last month, indicating ongoing buoyant demand. This compares with 48.8 for the world, and India ranks amongst the top economy reporting robust PMI numbers. Domestic demand condition demonstrated remarkable strength with strong surge in factory orders. The second thing that is going well in Indian economy is the IIP. IIP growth came in at higher than expectation and surprisingly positively recorded a growth of 8.2% in June versus 5% in May of 2023. The recent figures for core infrastructure thereby indicating healthy growth in the economy. However, the demand side continues to remain weak on the global side. The negative is June CPI inflation increased marginally to 4.81% versus 4.31% in the previous month, mainly due to rising food prices. So far, commodity prices were falling. Of late, they have changed trend and most of the commodity prices have risen. Higher commodity prices and food prices may have an impact on inflation in the coming quarters. Let me talk about another factor which has bearing on food prices: monsoon. Pre-onset of monsoon, there was a lot of discussion about El Nino and La Nino and how the monsoon may be weaker this time. The initial feedback seems to be rains have been above normal. However, the spatial distribution is not good. We need to see how the entire monsoon ends up to conclude if it is normal or below normal. I would like to share some interesting analysis we have done on monsoon and its impact on Indian economy. In the last 20 years, there have been 7 instances of El Nino, of which 4 instances witnessed drought. That is in FY 2003, FY 2005, FY 2010, FY 2015 and FY 2016. These years witnessed moderate to very strong El Nino. FY 2015 and FY 2016 were exceptionally tough years from agricultural point of view, with 2 years of successful El Nino. The El Nino event was very strong in FY 15 and FY 16. This led to lower reservoir levels and prolonged moisture stress, adversely impacting Kharif and Rabi sowing in India. An El Nino event coupled with poor monsoon usually impact crop production, but the impact on food inflation is more tenuous and may depend on underlying demand. Usually, Kharif crop gets impacted and impact on Rabi crop is minimal. Statistically, relationship between El Nino and food inflation in India is weak. An El Nino event has not always resulted in a spike in food inflation. Of the 7 instances of El Nino, there was only 1 instance in 2009 where an El Nino event led to spike in food inflation. I can argue that food inflation was probably due to strong underlying demand for protein. This was the time when the allocation to Manrega was increased dramatically. While we may not need to worry about El Nino being the spoilsport, but what we need to be watchful of is the following factor: uneven distribution of monsoon. On an overall basis, India's rainfall level as of 20th July 2023 were higher by 7%. However, the monsoon has not been uniformly distributed. East and Northeast together have a deficit, and while Northwest region has an aggregate got an adequate rain, UP still is in deficit. Uneven distribution of reservoir levels. Overall, reservoir levels for the country are higher than the last 10-year average, but this too is not uniformly distributed, with eastern and southern India running a deficit. So the risk of El Nino seems to have receded, but its impact is likely to be more sentimental than in any economic parameters. Every day we have newspaper headlines scream that Indian markets are hitting a new high, and this is contrary to what is happening in the global financial market. Right now, as you would be having this niggling question, the markets have run up significantly. Does it make sense to invest right now? Is this the peak of the market? Would I be able to make any money if I invest now? In a growing economy, it is but natural for earnings to grow higher and higher. This has resulted in BSE Sensex hitting 10 new highs over the last 42 years. This is an average of one new high every 4 years. In the last 42 years, Sensex has delivered a CAGR of about 14%. Let us look, if you had invested at the peak of the previous peak and stayed invested till the new peak, how much return would you have made? This is exactly the current dilemma equity investors have. Out of the 10 peak-to-peak investment, there are 7 instances where you would have made a CAGR return of more than the average return of the last 42 years. Let us look at the 3 instances which did not make it above the average return grade. The first one was post Harshad Mehta scam. The market delivered a return of 4% CAGR. This also coincided with the Y2K impact in equity markets. If you had observed the previous time period, the returns were phenomenal. Hence, there was some sort of consolidation. The second instance was the period post the global financial crisis and the PIGS crisis, where the market gave a 5% return. Finally, between 2015 and 2020 peak, we had local issues like GST, demonetization, ILFS crisis, and the taper tantrum, which kept the CAGR return at 7%. It is interesting to note that the current peak has given a return of 13.6% and has taken 42 months to cross from the previous peak. In terms of returns and period, they were both more or less in line with the long-term averages. I would like to reiterate that while ups and downs are part of the equity market journey, we sometimes may feel that investing at the peak of the market is unlikely to yield positive return. What Peter Lynch said many years ago still holds true, and I quote, "You get recession, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You wouldn't do well in the markets." So let us now come to earnings. First, let us review near-term earnings. Coming to Q1 FY24, results which are currently being reported by the companies. Up to 26 July, 27 Nifty companies have reported their results. In terms of revenue, all of the companies have been able to either meet expectation or exceed them. Also, in terms of bottom line, that is profit after tax, 11 of the 27 companies have reported in-line numbers. Beat versus misses were almost evenly poised at 30% each. It is interesting to observe, sectorally, we have seen the global facing sectors, that's IT, Metals, oil and gas sector disappoint, but domestically oriented sectors like auto, industrials doing well. Result season trend seems to be in line with the macro trend. World is slowing down and India is a bright spot. Global inflation is still not in the respective central bankers' comfort zone, while Indian inflation has cooled off for the time being. We have seen mid-cap and small-cap companies reporting acceleration in earning. This is probably also a reason for mid-cap index and small-cap index outperforming large-cap index in recent times. Based on the current macro condition, we expect earnings to be in the low teens in the coming 2 years. At this juncture, markets are trading at a tad level higher than the historical valuation. Given our view on the underlying macro and the sector view, the key themes we are investing in are based on 3 C's, that is, credit, consumption, and capex. Let us look at each of the factors. First, credit. After a strong credit growth and credit cost under control, we continue to believe that there are pockets of money-making opportunity in BFSI space. It does seem the cost of deposit are at near peak. Hence, there are pockets of growth opportunity even in other sub-segments of BFSI besides banking. The second one is consumption. Consumption is an evergreen sector in India given the demographic profile. In recent times, the sector was impacted due to slowdown in rural demand. While the demographic dividend in consumption is always true and we are seeing green shoots in rural demand, but it is also too early to say if the rural demand is completely back given the backdrop of uneven rainfall dispersion. The third theme is capex. Finally, we are seeing India having a sustained capex cycle which should drive the industrial segment and manufacturing sectors. There have been multiple stimulus and manufacturing sector has picked up well in recent past. Favorable policy and business environment and multiple drivers including PLI schemes, China Plus One, improved capacity utilization, just to highlight few of the factors that has led to improved output. Going forward, we expect government capex to begin before central elections are announced. On long-term basis, we expect the greenification of environment to be the key catalyst for future capex in India. Thus, not only are there multiple factors in past, there is a positive trigger for future growth in industrial and manufacturing. Now, coming to our fund house and our funds and how are we positioned across schemes. In terms of sector weights, most of our funds are overweight on industrials, consumer discretionary and utilities. This is in line with our overall top-down view. We keep reviewing our investment thesis. Let us see how the 3 C's are positioned in economy at this juncture. First, credit. Credit growth remains strong for the system at 15 to 16%. Our channel check indicates that demand for retail loan continues to trend on a healthy level. Consumption. With the state and general elections approaching, we may witness some increase in government expenditure in the rural area, thereby improving rural sentiment and benefiting rural consumption. Third, capex. China Plus One story, along with the government's PLI scheme, has led to many of the global MNCs looking up to and moving to India for their expansion. Public capex in defense and infra has already picked up. Private capex continues to remain subdued as corporates await more clarity on long-term policies given the impending elections. We are underweight on IT sector and positively inclined to pharma sector across all our portfolios. In terms of market cap positioning, almost all our diversified funds have increased weights to mid-cap and small cap compared to the previous quarter. We continue to find interesting investment bottoms up opportunity at lower end of market cap spectrum. In our asset allocation fund, our Baroda BNP Paribas Balance Advantage Fund, net equity allocation is at about 67%. There has been a gradual reduction in equity by about 300 to 400 basis points over the last couple of months, purely reflecting the up move in the equity market. There are various product offerings, and depending upon your risk appetite, you may choose a suitable product to meet your financial goals. Before I conclude, I would like to talk about two of my passion, agriculture and investment, and how I see both of them are linked. There is a very famous proverb, the best time to plant a tree was 20 years ago. The second best time is now. On the lines of the same, what I would like to tell you from my own investing experience is that the best time to invest in equity market was 20 years ago. The second best time is now. Thank you for listening, and I would like to invite you to participate in growth story called India. Dhanyavad.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.